Okay, let's start. Now we are going to apply what we have learned up to now in macroeconomics theory into investment practice. And most of the time when you learn theory, you don't know how can we use it. So you're not that motivated to learn it because it's so dry and it's not exciting at all. So now I'm going to let you know how useful what you learned up to now in macroeconomics is to your investment practice. Right, the first thing is to know how to apply the theory. That's our 3 linear objectives. The second one is to know the 3 basic trading techniques. And the last one is to do it. Right? Maybe you would say, well, it's not that important for you to know this. Why do I have to bother? Why do I invest at all? Now let's imagine you are graduating at 22 years old, right, usually. And you can either choose to be a wage earner, to work for the Big Four or whatever you like to work for, at 20K per year. Well, this is not your before tax income. Let's say this is your after tax income. That is already quite high, right? 20K after tax is already quite high for a graduate. Another choice is to be an investor. You can earn 20% rate of return on 20K initial capital from your parents, for example. You have 2 ways of doing it. So what do you want to do? Which one would you like to be? Option A, as a wage earner or investor. Depends on how long you live, right? Right, let's say you are 40 years old. You choose one of these. What does it look like? If you are a wage earner, you basically accumulate the same amount every year, right? That's the blue line. It's linear because every year you accumulate 20K. So when you're about 37, like I'm 37, you will be able to earn about 300K. So back then, when you're 37 years old, you will own a house in a semi-detached house in good property. But if you are an investor, originally, you will be worse off than the wage earner. As you can see, it's actually a lower wealth compared to the wage earner in the beginning. But after 37, this person will exceed the wealth accumulated by the wage earner. Okay. So what about when you're 65 years old? What about 65 years old? You can't even see the difference. Because if you are a wage earner, when you are about 65, you barely can earn 1 million. Well, actually, not more than 800,000. So basically, you may have 2 households, you may have 2 properties, one in London, another one in Cardiff. That's the best you can do. But if you are earning 20% of rate of return on this initial investment, you will be able to earn 50 million. Wow, yeah, that is my reaction if I could do that. So you will be a millionaire, 50 millionaires wealth. So that is why you have to invest, because if you do not, you are going to be a poor person compared to those super rich. And if you look at the top 1% who are investors, the top 1% of the UK residents who hold how much of the share of the total wealth of the UK. In the beginning of the 20th century, the 1% people hold 70% wealth. And those people are the biggest investors in the UK. But after the Second World War, because of various reasons, they just the wealth share, top 1% wealth share decline. But still, nowadays, 1% of the investors holds 20% of the wealth in the UK. Think about that. If you earn your wage, you work your ass to earn this wage, fixed wage, you're accumulating your wealth linearly. It is something we call arithmetic series. It's just increasing one by one. But if you are investing, you're accumulating your wealth by your interest. It's interest on interest. So that is expansionary in the fashion we call geometric series. It's pure maths. If you know this difference, you will not be confused why some people are so rich and some people are so poor, because they are using different ways of accumulating their wealth. Right. I hope that will give you some hint why you should invest, even though just a little bit of your time and money. Okay, now let's apply what you have learned up to now in the previous 4 units, the macroeconomic theory, and how to apply this to investment practice. Actually, if you are familiar with the stock market, most of the investment happens in the stock market. You just want to buy a share of a company, and when this share goes up, then your wealth will go up. That's quite simple, very intuitive, very straightforward. But if you treat each country as a firm, then what is their share then? It's the currency. Okay, the currency is issued by the government. It's just like the shares are issued by the firms. If you know this link, then everything will become so clear and straightforward. So if you treat a country as a firm and you can treat the currency as a share, then if you want to buy a currency or sell a currency, you should use this isomorphic comparison. If the sales of a firm is expected to rise, then you're going to buy the share of that firm, right? Just like when we are talking about GDP. GDP is like the sales of a country. It's like the output of a country. So when GDP is expected to increase, then you are expected to buy the currency of that country. Still remember the 3 indicators I wrote in the first lecture? GDP, unemployment, and inflation. These 3 indicators are the 3 most important indicators for make a judgment. Which currency you should buy, which currency you should sell. And unemployment is just like the cost. If the cost is higher, you won't want to buy that share of the company. And if unemployment is going up in that country, you expect to sell this currency rather than to buy that currency, right? So similarly, the risk, the second dimension of judging if this share is good or not, is to see the uncertainties. If this company is experiencing some uncertainty, like Huawei in China, well, it is not a public company anyway. So its share price is expected to drop because you don't know how much market share it will seize in the future. Similarly, from the country's point of view, the stability, the political stability and economic stability counts. Think about the Brexit. Why British pound is going like that after the vote? Because no one knows where we are going. The uncertainty and instability will make it is risky. So the currency will be sold off. The third dimension of judging the profitability and the value of the share and the value of the currency is the debt ratio for the company. If it borrows too much, then it's quite difficult to get cash because most of its money is in debt. And inflation is something similar. If there is a high inflation and there is a high money supply, then the liquidity of that currency will be higher. Now, these are the 3 dimensions to judge the value of a firm and it is the same to judge a currency, the currency of a country, just to link the two so that it makes sense to you. And the performance of a country's currency and the performance of the stock of a firm can be realized in the two markets. If it is stock, then it's in stock market. If it's the currency, then we are talking about the forex market. Okay, so what is forex market? The forex market is a short phrase for foreign exchange. It's called forex market for short. And it's basically the international money market. If you want to buy any money, you have to go to the forex market. If you go to, let's say, any Thomson Cook, well, it's no longer there. Anyway, if you go to that Thomson Cook, you want to buy some euro to travel to Italy. And you will have to buy something that is on the forex market. So you can think of the euro is now dropping down because no one wants to go to Italy now. Right. Unlike the stock market, however, you don't have a single currency to denominate each currency. Right? We don't have a world pound or world dollar. That is something which really exists in the stock market. For example, in the British stock market, you can buy Lloyd's using pounds. You can buy British petrol using pounds. Their share price is denominated by pounds, the same currency. But if you are talking about currencies, then currency and currency have to be paired to be denominated. You don't have a single world currency to denominate each currency. So they are relative to each other. They are in pairs. There are some major pairs. The major pairs all involves the US dollar. This US dollar, because the US dollar is kind of the world money. Everyone treat that as a baseline. So something like Euro/USD, that means how much USD you need to buy 1 unit of euro. 1 unit of euro. Anything appear in the first place is the denominator. And the second place currency is how much you need to buy the first place currency. So Great Britain pounds, 1 pound is equal to, let's say, 1.5 USD. Okay, so this should be 1.5 rather than 0.7 or something. Anyone knows what is CHF? Now, this is a major country, so it has to be a major currency. Yeah, Swiss franc. It's actually Confédération Helvétique franc. Well, just to show off my French. Anyway, so this is basically how much Swiss franc you need to buy 1 unit of US dollars. Right, Canadian dollar, right? That is Australian dollar and New Zealand dollar. So that is the 7 most important pairs, currency pairs you can see in the forex market. They are called major because each are quite liquid and everyone can buy this 7 pairs in the forex market. You can also trade some crosses. And this is called cross because this pair does not involve any USD. See, this is so. If you are using the convention of denominating, what does that mean? That's 1 euro is equal to how much Great Britain pounds, right? And this is something like 0.8 or 0.9. And exotic pairs are something that involves developing countries' currencies like Chinese yen or Indian rupees or Russian rupees. I don't know why Indian and Russian use the same name for currency. They're all rupees, right? Anyway, right. So this is the basics of forex market. I'm going to ask you a question. I'm not going to give you the answer. When does the forex market is open? We all know that the stock market begins at 9 and closes at 5, but when does the forex market begins? And when does it close? Google the answer. Right, so here are some basic jargons before you can actually trade. First, what is exchange rate? The exchange rate is the price of a currency in terms of another currency. So in this way of writing, euro/USD, that means how much USD you need to buy or sell to buy 1 unit of euro. And similarly, in this pair, sometimes the USD is in the first place, sometimes they are in the second place. It depends on how big is the face value, right? If you are using the reverse way of Japanese yen, Japanese yuan is very small in amount. So you can't say, 1 Japanese yen is equal to 0.0, several zeros and digit. It's quite inconvenient. So that is why we tend to put the more valuable currency in the front and then use the lower amount in the second place. And whenever you look at all these exchange rate, it always have 2 quotes. The first one is have a bracket with S in it. The second one is having a B in it. Because some people in forex market wants to buy euro. Some people wants to sell euro. The price of the selling price and buying price will be different. And for example, if you are selling euro, then you will get 1.0425 USD back. If you are buying euro from the forex market, you are going to pay this amount, which is different from the selling price. And the gap is actually what we call spread. Spread. It is something like, if you are a seller of Apple, you buy Apple at £1. When you sell it, you want to earn some profit, right? So this profit will be equal to the gap between the two selling price and buying price. And this is something we call spread. And the spread depends on the PIP. PIP is price interest point. That is the last digit. So if we are talking about this quote, then the PIP is equal to 5. And the PIP for the buying price is 8. So the last digit of a quote is called PIP. So the spread is equal to 3 PIP points, right? 3 PIP points. 3 pips, if you want to make it even shorter. Because 5 and 8 has 3 pip difference. A higher spread means a lower liquidity because you will have to go through some transaction cost before you can actually liquidate it. So this is some basics. And here is a candlestick or K chart to summarize what happened in the price of an asset. It is also used in stock market, by the way. It is not only in the currency market, but also in the stock market. First of all, what you can see is it green or red? Green means over this period, it is a rise. If it is red, it means it is a drop. However, this is a reversed tradition in the Asian countries. So if you are going to China or in Hong Kong, in Japan, in Korea, then this is the reverse. Green means going down and red means going up. Anyway, that's just the reverse. Just like the UK drive on the left and the US drive on the right. It's just a different tradition because the Chinese like red. Anyway, so if we are in the UK, then green means grow. Green means something life. And red means warning, so it is going down. And the tips means the highest level or lowest level, depending on a drop or the tip at the top is the highest quote during this period of time. And lower tip means the lowest quote during this period of time. And the upper edge is the closing quote. If it is growing, because the lower one is the opening, it has to grow, right? It starts from there and goes to there if it is a grow. But if it is a drop, the upper part is the opening quote and lower part is the closing quote because it is going down overall. So this is basically what we have. And if I show you in reality, this is real-time forex market between the Great Britain pounds and USD. So what does that mean, by the way? Great Britain pounds / USD. That means how much 1 unit of pounds is equal to if you want to buy it using US dollars, right? How much US dollars you have to spend for 1 pound. So for the previous, well, let's use minutes. For the previous units, you see it is updating every second. For the previous unit, it is dropping, right? It is declining. It is even declining further. So this tip tells you, well, so the USD, you need less USD to buy 1 Great Britain pounds. That means the Great Britain pounds is depreciating. It becomes weaker in the last minute, right? And for this minute at 3 o'clock, that means Great Britain is becoming stronger. It becomes stronger. If you use different period of time, let's say you use 1 hour, you can see a different pattern. You see, although it is declining in the last minute, but for the last hour, it is actually going up, becomes stronger. Okay, this is how you can tell from the candlestick or K chart what happened in the last several minutes or hours or even weeks. I hope that is straightforward to you. Some of you may already know that. Right. Here are also some other jargons you can use to describe the market. If it is going up, then it is called bullish market or bull market. If it is going down, it is bearish market. That is why in the Wall Street there is a bull, in the front of the Wall Street. So everyone wants it to grow. And another thing you can do is to use leverage. If you only have $50 in your pocket and you really want to make a fortune, then you can use the 100 leverage. X is actually multiply. By using your 50 capital, you can actually leverage 5,000 capital. You borrow the rest of the money from the bank and you invest in something. This is how you leverage up your profit. You don't have to just use your own money. You can just leverage up. But if your loss is greater than your capital, if you are making the wrong call, you are making the wrong judgment, and your loss is exceeding your capital, your position will be closed automatically, because the bank will not take any risk of your investment. As long as it is 50, you lose everything you have, they will take away everything else, right? Just like you buy a house, right? If you can't repay your payment, then the bank will take away your house. It powerfully magnify your profit as well as your loss. So be careful of using leverage. Don't be too greedy. You are very keen to use that. I understand that. I'm personally earn a lot using leverages, but also lose a lot during my experience. And there are 2 parameters you have to set whenever you open a position in the financial market. The first one is called take profit. We usually use a circle to indicate that. Take profit means, for example, if the current price is £1 and you want to take profit when the price rises to 1.2. So you set the take profit as 1.2. When the price goes to that position, it will directly close the position and you can take profit. So that is the first parameter you have to set. Another one is called stop loss. If instead of going to 1.2 as you expected, it goes down to 0.9, you're making a loss. And you can set this parameter in advance to stop your loss. Whenever the price is lower than 0.9, it will just close your position directly, automatically. That is set by yourself. You can revise that anytime you want, but that is something you have to set in the position. Okay, stop loss and take profit. That's the two. So the first trading technique I want you to know is a long position as long as you know it is going up. No matter it is the currency or a stock you're buying, you expect it to grow. So you will set a long position. A long position look like this. The take profit parameter is up there, and the stop loss parameter is down there. So if the current position is $100, you're buying something like US dollar using your pounds, and you expect the US dollar to grow, to appreciate to 110 in value. So if you know that for sure, if you can foresee the future, then you should set a long position like this. So if it goes up to 110 as you expected, you will take the profit, which is equal to 10. You can magnify this by leverage. You can magnify it by another 100 times, so you can earn a profit of 10 multiplied by 100. But if you lose, if it goes down, you will lose at maximum at the stop loss. Okay, the stop loss. You don't have to lose everything. You just stop loss at a position. Okay, this is the first technique. Well, it is not really a technique. As long as you know the future is going to see a rise in value of that asset, you should place a long position. What about if you foresee that it is dropping? You can still make a profit by putting a short position. This is done by this. You place a stop loss up there and take profit there. You just place the short position. The software will automatically do it. So what you can actually put profit in this way is that imagine you have no money and no assets at all, but you have information. You know the price of that asset is going down. So what you do today is you borrow 1 unit of that asset. Okay, you borrow it from someone and then sell it right away at the present value of $100. Okay, you sell it right away. And then when it actually drops to, let's say, $90, you will buy it back and return this asset to the person you borrowed it from. So what you actually have is a $10 profit, right? Because you sell at high and buy it back at low. And the gap between the two prices is your profit. This is called short position, or basically you short it. Because you actually don't have it, so you are short of it. But you can use this position to earn a profit. Okay, that's the second technique. They are quite basic. As long as you know the future, then you should be able to do it. What if you are not sure about the future? We are not God, right? We don't actually know what is exactly going to happen. You don't know it is going to rise or going to drop, but you do have a guess it is going to have a trend. It is either going up or going down. Then we have 3 types of market analysis to help you to forecast. The first one is called fundamental analysis. That is actually what you have learned in macroeconomic theory up to now. Just to make a judgment whether or not your GDP is going up, whether or not your unemployment is going to rise or drop, whether or not your inflation is going up or down. And this is quite straightforward. Just treat the GDP as the revenue of a firm. If GDP going up, this country's currency is going to be stronger, right? Because the revenue go up, you want to buy it. So you should place a long position for any country with a higher GDP expectation, right? That's the first thing you have learned from macroeconomics. Another one is inflation. If inflation is going up, do you need more money to buy that goods in that country, right? Inflation means price is going up. So you will need more money. If you need more money, the price, the value of that currency will go up. Straightforward, right? Another one is unemployment. If unemployment goes down, that means the economic performance of that economy is going to be better. So you're going to long or short. Come on. If the unemployment rate is going down, would you short or long this currency of that country? Do you know what I'm talking about? It looks quite confusing in your face. Unemployment, is that a good thing or bad thing? Bad thing, right? If there's a bad thing and it goes down, then that's a good thing, right? If there's a good thing, then you long it. That's so simple, yeah. And how about interest rate? If interest rate go up, that means when you hold the country's currency, you will get a higher pay, right? It's like the profit rate of holding that country's currency is going up. Is that a good thing or bad thing? If there's good thing, you long it. If it's a bad thing, you short it. As simple as that, okay? That is a judgmental call. So I'll give you these examples. If the Federal Reserve is going to raise the policy rate or the interest rate, you're going to long the US dollars and short everything that is denominated by the US. If you forecast the unemployment rate in the UK is going down, then you're going to long the Great Britain pounds, right? And what if Brexit happened? You know Brexit is going to happen. Is that a good thing or bad thing for the UK? You don't know, right? But it gives you uncertainty, right? It gives you uncertainty. Any uncertainty is a bad thing for asset because you don't know what is going to happen. So that will make Great Britain pound to crash. Right. Apart from the economic theory we can use to forecast, another analysis is called technical analysis. Technical analysis is something like this. I can show you here. Well, just to, whenever you go into this platform, you will see different pairs. Let's say just, you can even trade Bitcoin, by the way, and other stock market can also be traded in this platform. You don't have to just trade currencies. Right, let's just use the example chart. Okay, go up there. And if you want to know the trend, you can use technical analysis. Basically, you can use this channel. You can use this channel to analyze if it is going down or going up. The upper part is called resistance. So any value go below this part is it will go below this channel. And the beneath line is called resistance channel. So any price won't go below this line. It will bounce back. As long as it is exceeding this level, the trend will change. But anyway, this is just some technical analysis to guess the trend. You can't rely on that. The fundamental analysis is more important, right? And if you want to learn technical analysis, you can Google it. There are loads of tutorials out there. It's much better to learn yourself rather than learn it from me. And the third one is sentiment. What is sentiment? Sentiment is the real-time market sentiment. You can see from the watch list here. The sell and should have more sentiment measures. Right. Well, you can see that this is the sentiment. How many people are going to buy and how many people are going to sell? See, this gives you the sentiment of the market. How many people are doing it now, right now? So you can make a judgment call using this sentiment indicator. If many people are buying, then you can write down the trend. But if too many people are buying, it is not a good thing. Okay, it is not a good thing. If everyone is buying, that means it is overrated. It's telling you the pessimistic or optimistic sentiment of the market. So basically, we can use these three types of market analysis to judge the trend or to forecast. Is it to place a a long position or short position? But the third technique, which I'm going to focus on, is called hedging. This is used by a lot of hedging funds or fund managers in the financial market. In practice, those people work in the Wall Street in London, they are frequently using hedging techniques to gain a profit, a risk-free profit. I'll show you how powerful this is. And as long as you know there is a trend, but you don't know it is trending up or down, you can use hedging to make a profit. Let's use an example to show you the case study. This is the Brexit event on 23rd June 2016. I earned a handsome profit out of this, by the way. Sorry, Britain, but yeah. So if you look at the Britain pounds value, Great Britain USD, during that period, it's quite flat. But there will be either a crash after Brexit wins or a surge if Remain wins. We don't actually know. Imagine you are standing at this point, standing before the night of the vote, of the referendum. You actually don't know who is going to win. So what can you do? How can you make a risk-free asset? Well, you could say, well, I just gamble it is going to win. But what if you guessed wrongly? Then you're going to make a big loss, right? So what we are going to do using the hedging technique is like this. First, the first step is to set a long position like this. Okay, a long position. So you expect, as if you expect it to grow. You expect as if you expect the Remain campaign will win. Okay, so if Remain campaign wins, then your Great Britain pounds is going up, and you are going to take a profit there, and this stop loss parameter doesn't matter. And at the same time, you're going to set a short position as if you hope the Brexit will win. Okay, because you actually don't know that, but if you are going to win as a Brexiter, then you should place a short position like this. This cross means stop loss, okay? And if it wins, you will make a profit hitting the take profit point there. But the position of the stop loss and take profit should be like this. So the stop loss for the long position is higher than the take profit position in the short position. Okay, just like that. It's quite straightforward and intuitive. So let's analyze the two scenarios. First, if it is a rising trend, the short position will be closed right away, right? Because the stop loss will be hit. The stop loss parameter will be hit by a rising price. So you will take loss at this amount. But you will hit the take profit position later on because it is going up. So at the end of the day, you will earn a profit which is equal to the gap between the take profit position of the long position and the stop loss position of the short position. You will earn a profit between the two, right? Does that make sense to you? And if there is a short position, if it is going down, the short position will win. And you will hit the stop loss for that position, for the long position first, and then hit the take profit position later on when it drops to the take profit position of your short position. And again, you earn that profit, which is equal to the gap between these two positions. And on that day, I set exactly the same hedging positions, the two positions, and used 200 times leverage, very greedy. And the long position was set at this, and take position is that. So that is my position on right before the referendum's result. And then the short position is reversed, but with a little bit lower stop loss than the take profit. And when it actually happens, I'm not risky at all. I'm just waiting to see the result, which will win. Whoever wins, I will take a profit. And at the end of the day, I actually take a profit for the decline trend. And the gap between the take profit of the short position and the stop loss, well, I do have a loss first, but the profit is greater than that. So this is something you can use in your practice to hedge against any risks. As long as there is a trend, even though you don't know it is trending up or down, you can still take a profit. That is why George Soros earns billions of pounds over the 1990s, because he just keep using that. You know, even though you have a wrong guess, you're still getting something out of it, right? Does that make sense to you? Yeah? No? Yeah, think about it. And how can you make this, you know, two opposite positions to make a profit? I hope you can use that, practice that in the actual game. Okay, but there is a risk as well. If you don't be careful, you can hit the stop loss too soon and never hit the take profit point. So make the position a little bit narrower. So now I'm going to announce this trading game competition from today. And don't use your real money right away, okay? The Cardiff University is not going to take the risk if you lose all of your money. Actually, one of my colleagues in Wall Street has killed himself just because of this. Yeah, well, anyway, that's a sad story. In 2008, I came here in 2007 to do my PhD by quitting the investment bank. I think I'm making the right call. And he didn't do that. But in 2008, he's losing everything. Anyway, register your eToro using this link. Please use this link only because that is the only way I can verify you participated. And this will be the basis for me to judge if I should give you the 5 marks in your exam. Okay? No matter how much performance you get, as long as you participated, I'll give you 5 marks. But if you don't, then I can't give you that 5 marks. It's just an opportunity to let you know your potential. I think some of you never know your potential. Probably you're in the next George Soros. Right, after registration, you have free access to the trading classes. You know, you can click the thing, or you can just Google it. And use the virtual money. You know, this is the virtual money of $100,000. This is virtual, but it is good if you really have that money to invest. You can invest on Forex, you can invest in gold or oil or whatever, commodities, or stock market, or even social trading. Social trading means you just copy someone else. And if this guy is trading, you copy all the strategies of that account. Try to maximize it, and you should do it by learning. Okay, Google could be helpful, and don't place a position when you are hungry, or angry, or sad, or just break up from your girlfriend or boyfriend. Don't occupy your study time, but try to use our macroeconomic analysis to do your trading. Okay.